Welcome to this session of Accounting for Decision Making for MBA of Anna University, Unit 1 Financial Accounting. Here we are learning Introduction to Financial Accounting. In this video, we are going to learn about the accounting equation and the preparation of journal. Then, accounting equation. The relation between the assets of the business and the proprietor's capital and liabilities is called the accounting equation. So that it can be represented as assets equal to capital plus liabilities. A business receives capital from the owner and also borrow money from banks and financial institutions. From this money, it purchases fixed assets and keeps some money for the day-to-day expenses, which is called working capital. Here the total assets would always be equal to the capital. Here we are taking an example that a proprietor is going to invest a fund of rupees 10 lakh in a business. If the amount is utilized for the purchase of fixed assets like land and building for rupees 5 lakh, machinery for rupees 3,50,000 and balance cash for working capital 1,50,000. It can be represented as assets land and building 5 lakh plus plant and machinery rupees 3,50,000 plus cash 1,50,000 equal to capital 10 lakh. This the business can borrow funds from outside also for acquisition assets and for working capital purpose. This it is called a liability. Therefore, the capital and the liability should be equal to the total assets of the business. Generally, we are calling it as liabilities. That liabilities includes owner's fund and outside is money. That owner's fund may be represented as capital. That here we are specifically mentioning capital plus liabilities. The account equation accommodates assets, liabilities, capital, income and expenses. The income and expenses are not shown in the balance sheet directly. It is recorded in a separate account called profit and loss account. The net effect of the income and expenses is transferred to the capital. If there is excess income over expenses, it is called a net profit and it is added to the capital. If there is excess expenses over income for a period, it is called net loss and it is deducted from the capital. In this way, the condition of the accounting equation will be satisfied. The accounting equation is recorded in a statement called balance sheet. Since the net effect of all the debit and all the credits is recorded in the balance sheet, the assets and liability side of the balance sheet are equal. Asset side and liability side would be equal. Hence, we know that the accounting equation represents assets and liabilities. And rules of accounting equation. When we are before going to the rules of accounting equation, we should keep in mind about the assets, liabilities, income and expenses. In the liabilities, we are taking capital since it is more important, we are showing separately. And hence, we just see that when debit increases assets, because assets will also show a debit balance. Credit decreases the assets when due to sales. Debit decreases the liabilities. Liabilities means amount paid. Then credit increases the liabilities means borrowing and capital receipts. That when owner invested additional fund, that coming into that increases the liability. Debit decreases in capital because capital always shows a credit balance since it is in the liability side. And credit increases in capital. Debit increases in expenses. Expenses always shows a debit balance. So the debit increases expenses and thereby credit decreases in expenses. Debit decreases in income because income shows credit balance. Hence credit increases in income. And let us see the procedure of double entry system. The procedure means first record in journal, then post it into ledger, then preparation of trial balance, then preparation of final account, that is trading, profit and loss account and balance sheet. First recording in journal. Recording in journal is known as writing in subsidiary book or book of original entry. The transaction should be recorded first of all in the journal. All the transactions should be classified into two aspects and they should be debited and credited in two accounts. For example, sales of goods, that would be divided into sales and cash, thereby cash account data to sales account. Next, posting to ledger. Posting to ledger is otherwise called as posting to primary book. since ledger is called primary book. All the transactions recorded in the subsidiary book, that is journal, should be posted into respective accounts in the ledger. Hence a ledger is a collection of different accounts. The accounts may be like salary account, purchase account, cash account, X account, etc. These accounts are named as real account, personal account and nominal account. As per the principles of accounting, these accounts are debited or credited. For every debit in one account, there would be corresponding credit for the same amount to another account. Ledger accounts may be 100 or 150 or even 50 accounts, whereas journal means there may be legs and legs of transactions. Transaction to be recorded. Then third one is preparation of trial balance. After preparing the ledger accounts, these accounts may be showing balance. For example, sales means that will be showing only that credit balance, and that all the account posting should be added, and it would be taken as a credit balance and should be written in trial balance. Trial balance is prepared in 3 columns. One is to write the account's name, another 2 columns for debit and credit. The sales account means credit column, and purchase account means that would be written in debit column. Like that, any expenses means debit column, and capital means credit column. Then after that, preparation of final accounts. From the trial balance, the account should be taken and it would be written in trading and profit loss account, and then to balance sheet. These accounts are prepared from the balances of different accounts from the ledger. These balances can be easily located from the trial balance. Now let us study 2 illustrations. First illustration, journalize the following transaction in the book of K Limited. Here there are 8 journal entries, transactions are there that would be written in journal. First, sold goods for rupees 10,000. It would be divided into sales account and cash account. So cash is coming in, then cash account should be debited, sales account should be credited. Purchase goods means cash is going out, since that would be credited. That means to cash account, thereby corresponding purchase account should be debited. Purchase goods for on credit from Joy means that would be purchase account should be debited and Joy account should be credited. Sold goods on credit, because goods is going out, then sales account should be credited. Northern bought on credit means that northern account should be debited. Salary paid means salary is a nominal account, that should be debited. Cash is going out, so salary account debtor to cash. Paid to Joy means cash is going out, so to cash account. Then to whom it is going? Joy. Joy account to be debited. Received cash from Northern means cash is coming in, cash account should be debited. From whom it is coming? Northern means to Northern account. Sold goods to Vimal for cash means cash is coming in, so cash account should be debited. So Vimal account should be, Vimal should not be credited, sales account should be only credited, because it is a cash transaction. Now let us study illustration 2. Here 10 transactions are given. First one, purchase goods from Vijay on credit. Means that purchase account debtor, since goods is coming in. Then to Vijay account. Vijay is the giver, hence Vijay to be credited. Then sold goods to Raj on credit. Means sales account should be credited, and that Raj account should be debited, since Raj is the receiver. Then purchase goods for cash means cash is going out, so purchase account debtor to cash. Sold goods for cash means cash is coming in, cash account debtor to sales. Paid to Vijay for goods purchased on credit. So on credit we bought 7 goods for 7,500, hence the cash is going out, and that cash account 7,500. To whom it is going? Vijay. Vijay account debtor to cash. Cash received from Raj, because Raj bought goods on credit, hence we sold to him on credit. Thereby cash is coming in, cash account debtor to Raj account. Withdraw from bank for personal use means owner is drawing money, hence it would be written in drawings account. So drawing account debtor to cash account. Then borrowing, or it may be written as bank account, since he is directly taking from the bank. Then borrowed from bank rupees 6,000 means cash is coming in, cash account debtor 6,000 to bank account 6,000. Wages paid 2,550 means Wages is a nominal account that would be debited. Wages account debtor to cash. Cash is going out. Additional capital introduced means capital is a credit balance room. Then it would be cash is coming in. Cash account debtor to capital account.